Hi, and welcome back to the Rich Life Diaries. So, in today's episode, I'm going to be talking about bad investments in 2026. So, let's get into it. Welcome to Rich Life Diaries, the podcast where we talk real strategies for creating abundance, building a business you love, and designing a life that actually feels good. If you're done playing small and ready to create your dream life, you're in the right place. So, as some of you know, I have been self-employed for 18 years and I've made a lot of money and I've lost some money. And I've watched a lot of people make the same mistakes over and over again. So, this is not advice from someone who's just read some stuff in a book. This is stuff I've actually lived in real time and I've actually learnt from being around wealthy people. In my opinion, there are 6 things I would not be putting my money into in 2026. Now, this is not financial advice, so I need to be clear. It's just me sharing what I have personally learned. So let's get into it. Number 1, crypto outside of Bitcoin. Now, before you come for me in the comments, hear me out. I'm not anti-crypto. Bitcoin has proven itself over time. And personally, I've invested some of my own money into Bitcoin. And if you look at Bitcoin over the last 10 years, if you put $10,000 of your money in 10 years ago, that 10K would now be worth $1.7 million. So it's got pretty insane returns. But the altcoins, the random coins with the cute little names and the big promises, that's a different story. Most of them are just driven entirely by hype cycles and influencer marketing. And when the hype dies, so does your money. So if you want to invest in crypto, just stick with Bitcoin. Everything else is basically the same as going to the roulette table at the casino and praying that the odds will work in your favor. Number 2 is shares outside of index funds. Look, unless you are a professional investor with time to research companies deeply and daily, you are not going to consistently beat the market. Nobody is. Even most fund managers don't beat the stock market. But what I do believe in is index funds, things like the S&P or Vanguard. With index funds, you are buying a share of the whole market, not just access to one company. And when the economy grows, you grow with it. You're just not betting on the one company. You're betting on a whole system. And over the last 10 years, the average return for the S&P is sitting around 15%. And Vanguard, I think, is around 14%. So when you compare that to individual shares like bank shares or company shares like BHP or whatever, they sit more around 5% returns. So there just really is no comparison. Number 3 is NFTs. Now, I'll keep this short because honestly, the market's already said everything that I could say. The NFT market peaked in 2021. At one point, people were paying millions of dollars for digital images of cartoon monkeys. Like, the total market has since dropped by over 95%. The people who got in early made money, and the people who bought in because they saw it on Instagram lost their money. So if someone is still trying to sell you an NFT in 2026, run the other way. Number 4 is property in low growth areas. Now, I love property as an investment, and I know a lot of wealthy people who have made a lot of money in property, but not all property is equal, not even close. And there are parts of Australia, like regional mining towns are a classic example, where prices were inflated by a mining boom. People bought in thinking that they were going to get a bargain, and then the industry shifted and those properties dropped by 40, 50, and sometimes 60%. And places like Blackwater in Queensland are a great example of this. Now, I can speak from experience on this one because I actually bought land and built houses up in Blackwater just before the boom. Now, back then I paid about $750,000 all up for 2 houses and land. And honestly, I was getting crazy rents in their peak. I think I was getting around $1,600 each house per week in rent during the boom. And then when the boom flopped 2 years later, those same rents went right down to $400 a week. Now, from a rental perspective, that's still a pretty good return. But over 10 years later, I literally sold the houses for almost what I paid for them. So the capital growth doesn't move in those areas. And while the high rents are really nice, the people who make real money are in property are reliant on the capital growth, not net returns. So I remember back when I was in my late 20s, before Gold Coast was a popular place to live, and I actually used to sell real estate here. And I remember many places we had listed were selling for the same price the vendor paid for them 10 years prior. Now, obviously, that isn't the case now, thanks to COVID, but for decades, most areas in Queensland were not a great place to invest in. So, like most things, it's a supply and a demand thing. So, good places to invest in would be where you have huge demand and limited supply. Overall, when investing in property, you want to look for population growth, infrastructure, employment diversity, and ideally close to a capital city or major economic hub. If a property doesn't have those things, the cheap price isn't a good deal. It's just a warning sign. So buy in areas where people actually want to live, not just where the numbers look cheap on paper. Number 5, leasing a fancy car to claim it on tax. So when I bought my new Mercedes, people were coming out of the woodwork and telling me that, I should lease it and not use my cash and all this type of stuff. So anyway, I ran the numbers before I purchased the car. Now the car cost me $105,000 and I ended up actually paying cash for it since I had the money sitting there anyway. But let's say hypothetically I did lease the car over a 5-year period. Now, this would have cost me $2,200 a month in lease repayments. And over 5 years, that's around $132,000 in payments alone. And then at the end of the lease, you still don't own the car because they will charge you like a residual payment, which will be around $30,000. So you have to pay that if you want to take ownership of the car. So that $105,000 car has now cost you potentially $160,000. And that doesn't factor in the luxury car tax threshold, which in Australia sits at around $80,000, which means your depreciation deductions are capped anyway. So the tax benefit is nowhere near what people think it is. Anyway, as I said, I end up paying cash for the car, which means I own the car. I don't have monthly repayments or interest on it. I don't have any debt on it, and I sleep better at night knowing that the car is mine. Now, don't get me wrong, leasing can make sense in some situations. So if you don't have the cash or if the car is an electric vehicle with the FBT exemption, there are scenarios where it works. But the blanket advice of lease it for the tax deduction without actually running the numbers, that is how people end up paying significantly more for something than they need to. Anyways, my point is always do the maths before you run out to lease that Lambo. So number 6, investing in advice from the wrong people. Now, this last one isn't really a financial product, but I'd argue it's the most expensive investment mistake that people make. And that is listening to broke, unhappy, risk-averse people for financial advice. You wouldn't take dieting advice from someone who's never lost any weight. You wouldn't ask someone who has never run a business how to build one. So why would you take investment advice from someone who has no track record with no money? So I recently had a lead come to me who wanted to start a business and she kept hesitating. And when I dug into it, she told me her accountant had advised her not to start because the share market was about to crash. Her accountant, who was an employee, who has never run a business before. I mean, telling someone not to start a business because of economic conditions. That is not financial wisdom. That is someone projecting their own risk aversion onto your life. The people giving you the loudest warnings are often the people that have never backed themselves, and they'll dress it up as concern. They'll call it being realistic. But what it really is fear, and fear is not a financial strategy. Be very selective about who gets access to your mindset around money, and surround yourself with people who are actually building real wealth, who are actually taking calculated risks, and who are actually living the kind of life that you want. Because whether you like it or not, you do absorb the energy and the beliefs of the people that you spend most of your time with. So those are my 6 investments that I'd be avoiding in 2026. Crypto, random stock picks, NFTs, cheap property in the wrong areas, leasing a depreciating asset, and investing in advice from people who haven't done what you want to do. Now, if you found this video useful, make sure you hit the subscribe button, and I look forward to seeing you back here in a couple of weeks.